What's going on, everybody? And in this video, we are going to be talking about dividend investing. Is it really worth it? And a little quick spoiler is I believe it is, and I'm going to be going over why I do believe that dividend investing is worth it. I wouldn't have created this portfolio, I wouldn't have created this channel if I did not think that dividend stock investing was worth the money. So before I go any further in this video, if you enjoy dividend stocks, if you enjoy dividend investing, just investing in general, stuff about passive income, how to make money within the stock market, make sure to give this video a thumbs up and you subscribe to the channel. And I'm going to be going over pretty much six different reasons on why dividend investing is really worth it with historical proof. So if you have any other reasons why you think dividend investing is worth it, make sure to leave a comment down below what you think that reason is. I would like to hear your guys' inputs and opinions. But enough of that talk, enough of the intro. Let's get into this video. So what we're looking at right now is my portfolio. And the S&P 500 has been a little bit crazy over the past few months. I guess you could say just a whole. But over the past day, I'm actually down $56.10. And over the past week, I'm up $11.47. Past month, I'm up $590, which is 6% return in 1 month. And I do believe that dividend investing has a lot of upside potential. Now, if you're looking to get into dividend investing, or you just want to see it, or you haven't signed up for M1 Finance, make sure you use the link in the description down below, or in the comments. It's going to be in the pinned comment. You can use my link. You and me both. If you sign up with that link, you will get $100 free on M1 Finance, $50 free on M1 Finance by depositing $100 or more. So there's a lot of upside potential. You get 50% ROI, and you can literally go check out my entire portfolio if you would like to see what I'm investing in. There's a link down below. It's all free. Thank you so much. But let's get into why dividend investing is worth it. So first off is the dividend yield on cost that one can receive is mind-blowing. Let's take Warren Buffett and Berkshire Hathaway, for example. As you read right here, where my cursor is, it's a little bit small, and I wish I could zoom in, but I don't really know how. So sorry about that. It says, in fact, one of Buffett's most famous investments now pays Berkshire a 50% annual dividend yield on his initial investment. Not only that, but it's one of the safest stocks around. And he gets that from Coca-Cola stock, ticker KO. He's making a 52% annual dividend yield on this stock. Okay, you can see it's actually an exact yield of 51.7%, but still, that's insane stuff. They invested overall $1.3 billion in this company, and Berkshire is going to be receiving $672 million in dividends. Like, that's mind-blowing. 52% dividend yield. Like, that's every 2 years, he's making his investment back because of passive income, and then every 2 years after that, he's doubling it. And he's just making more and more money, compounding passive income. And that's what you get whenever you buy low and you buy early, I guess you could say. And then as these companies grow in stock price and they increase their dividends, you're just a shareholder who's going to be receiving those passive income benefits. And just to put things into perspective, Coca-Cola has a current dividend yield of 2.75%. And now he gets an annual dividend yield of 52%. That's all about yield on cost, being patient and buying and holding. And also, I will mention that Coca-Cola had a 3% dividend yield whenever he bought in. So keep that in mind. Now let's go into reason number 2. Is dividend stocks are just better in bear and flat stagnant markets. And I think that I'm not 100% saying I know where the market's going to go, but current timing in the market could translate to this. And I say that because of a number of different reasons in the economy and just what analysts are kind of expecting over the next year and next decade. A lot of analysts like Morgan Stanley and JP Morgan, a lot of analysts at these big firms are saying that the 2020s will be a lost decade, meaning that stocks either lose value over their entire decade or that they stay flat. And let's say in a hypothetical world that happens, how do you make any returns? You invest in dividend stocks. Like, that's the only way that you can, because you just have to, even in the 2000s right here, whenever the 2008 financial crash happened, the tech wreck, the dot-com bubble, and it just made stocks plummet. Dividends provided a 1.8% annualized return over the decade. Now, if you can either invest in dividend stocks and get a 1.8% 1.8% annualized return, or you could invest in growth stocks and lose like 30% of your money. And that's kind of the way to look at it. Now, when the markets are trading down or sideways, you're going to be getting that cash flow, and that's how these dividends are providing returns. And then they should hedge against inflation, although inflation is at really, really high rates right now. Now let's talk about reason number 3. Historically speaking, dividend stocks are just better. Like, just look at these images right here. Your average annual return on dividend stocks compared to non-payers is big. Usually the quintile 4, which is not the highest amount of dividend payers, but highest to average amount of dividend that they pay, received the biggest average annual return. And the highest amount of dividends paid received the second biggest amount of annual returns. The people who didn't pay dividend stocks from 1926 until 2013, or really from 1928 to 2013, sorry about that, your non-paying dividend stocks received the worst returns. So keep that in mind. Now you got dividend growers and initiators making biggest gains, and then your dividend payers, and then your regular S&P 500, and then your people who don't change their dividends, and then you've got dividend non-payers who had the worst returns, and then you've got dividend cutters and eliminators with the absolute worst returns, negative returns. So keep that in mind. Everybody performed pretty decent except for dividend cutters and eliminators. So invest in companies that can sustain their dividends if you're investing in dividend stocks. We can see, this is just a paragraph I want to read. Dividend paying companies are usually more established with a solid foundation and a pretty solid moat most of the time. And they usually have the ability to perform at better sustainable rates. And I say sustainable because a lot of growth stocks, for example, let's say, for example, something like Neo stock, okay, the EV company, went from like a penny stock to like $35 in a single year. It does not mean it's going to go from $35 to $3,500 the next year. Dividend stocks can continuously compound and perform great returns at sustainable rates. And usually, let's say in an economic downturn, growth stocks are going to get hit big, and there's no like returns if you're getting like cash flow from dividend stocks and no recovery. And oftentimes, when a growth stock gets hit, I'm not saying that when dividend stocks in an economic downturn get hit, like they don't fall in value like they do. But usually when growth stocks get hit, they get hit big, and they just get hit massive. And there's no return that you're making unless they go back up in share price value. Now let's talk about reason number 4. The dividend snowball effect, which is DRIP, and total return. So I have a little stutter right there. DRIP stands for Dividend Reinvestment Plan. Now let's just look at this image. Going back to 1970, 84% of the return of the S&P 500 can be attributed to reinvested dividends and the power of compounding. That's insane. Reinvesting your dividends makes your gains so much bigger, and they literally are paying you to make money. Like, that is what dividends reinvested are. Take, for example, you have a $100 invested, and then you get paid $2 in dividends. You reinvest that money. Now you have $102 to invest. And as you wait and you compound, then you get $102 the next time. Maybe they pay $3. Now you have $105. And it just keeps adding up. And as you add your own money, as your share prices go up in value, as your dividends get increased, you're just going to be making so much money you're not going to know what to do with. And dividend investing provides cash flow. And you take that money, you're literally guaranteeing yourself with income like we talked about. The more and more you invest and reinvest your dividends, the more your dividend income will be over time. So just be patient and let your dividend snowball roll down the hill and grow. Literally, it's just insane the upside potential you can see. Like, I remember whenever my portfolio was like $1,000, and I know my portfolio is not like massive or anything. Like, it's nothing I could live off of. It's like $10,000 some dollars right now. But I plan on investing more money, doing different things to get that number up, especially over the long term. I remember when my portfolio was like $1,000, $2,000. My dividends now are way bigger, and you can just see the growth. And it's really motivating to see that type of stuff. Now let's talk about emotions and why cash flow is king. Not necessarily cash is king. Cash flow is king. Now here's just, we'll actually finish with that. Now, don't get me wrong, investing and making gains on growth stocks is incredible. You know, like I do have growth stocks that I own. But cash flow is king. And in order to be financially free, you can't just rely on capital gains. You have to have consistent cash flow, passive income coming into the market. And also, dividend notifications are amazing in the morning. Like, there's nothing better than waking up and saying, like, oh, $11 in dividends? Great. Think about the day when it's $1,100. Just $100. Like, the more and more it goes, it's better. Now, there are usually two ways to become financially independent. The first and the most common is to have enough liquid assets that you won't spend lifetime, like, having $1 million portfolio and selling off 4% of it every year, making $40,000 a year by selling your assets. And the second and the much better idea is to have more passive income than your expenses, in other words, to have enough positive cash flow that could sustain you indefinitely. And that's what you get from dividend stocks. You get cash flow, and if you make the right investments, you should be getting share price appreciation, which you want both of them, in my personal opinion. And now let's talk about this. $4.12 in dividends isn't very cool, but the day that $4,120 in dividend rolls in, that'll be pretty cool. Keep building, stay consistent, don't give up. The process and the patience is definitely worth it, and that is what I have for you guys in this video. I'm not really sure why my logo and my banner's not loading, but if you enjoyed the video, make sure to give the video a thumbs up, and you subscribe to the channel. You turn on post notifications for videos coming out Monday, Wednesday, and Friday. Thank you so much for making it to the end of this video. If you want to, use my M1 link. You can go definitely do that. Get free $50 by depositing $100 and creating an account. Check out my portfolio if you'd like, and I will see you at the next video where I will be giving a portfolio update. And I do have a kind of big update in that portfolio about my portfolio. So thank you so much, and I will see you at the next video.